You pay your insurance premium every month. You assume you have a reliable financial safety net, ready to deploy the moment a sudden disaster strikes. Millions of people operate under this exact assumption, right up until they file a claim and receive a formal denial letter in the mail. The glossy brochures sell peace of mind, but peace of mind is a marketing concept, not a legal one. When you buy insurance, you are buying a highly specific, legally binding contract. That contract operates on one uncompromising rule. If a specific scenario is not explicitly written in the text, the insurer will not pay for it. Claim adjusters do not evaluate what you logically assumed was protected. They look directly at the clauses, limits, and definitions established on the page. The problem is figuring out what those literal terms are without spending your weekend translating 40 pages of dense legal jargon. By treating an insurance policy as a guaranteed safety net rather than a rigid contract, you stop actively managing your financial risk. You blindfold yourself to the exact scenarios where you have zero protection. To see how those blind spots form, we have to look at the standard health and auto policies most people rely on every day. With health insurance, choosing an HMO or a strictly in-network plan is a common way to lower your monthly premium. The trade-off is that you agree to only use their approved list of doctors and facilities. If you receive care from an out-of-network provider or undergo a treatment not yet approved by the FDA, the math is brutal. That bill becomes 100% your responsibility. Standard auto insurance operates with similar strict boundaries. Comprehensive and collision coverage will reliably pay out if you rear-end someone or your vehicle is stolen from your driveway. But standard policies are exclusively for personal use. If you turn on a rideshare or delivery app, you are now operating a business vehicle. If you get into an accident while carrying a passenger or delivering food without a commercial upgrade, your personal auto claim will be entirely denied. Opting for the lowest standard premium saves cash up front, but it shifts the financial burden of specialized, high-cost emergencies directly back onto your wallet. That exact same shifting of financial risk happens when we look at the physical structure of your house or apartment. A named perils policy only pays for damage caused by specific disasters listed in the left column, like fire or burst pipes. If an unlisted disaster strikes, like a flood, the resulting repair bill falls entirely on you. To reverse that setup, you have to upgrade to an open perils policy. An open perils contract flips the default rule. Instead of listing what is covered, it protects your home against every possible type of damage, except for a short list of specific exclusions. Because the coverage is so much broader, the technical risk of a claim denial drops dramatically. In exchange, the insurer charges a noticeably higher monthly premium. You cannot assume a homeowner's policy protects against all damage. The specific wording of those perils on the page decides who pays the contractor when the roof caves in. Moving past the physical structure of the building, we must evaluate the belongings you keep inside it. Standard policies apply strict per-item financial payout caps to your personal property, regardless of what the item actually cost you to purchase. If a fire destroys a high-end laptop or a thief steals an expensive piece of jewelry, the standard limit might only reimburse you a fraction of its true replacement value. This decision flow chart maps out your options. Once an asset hits the standard cap, you either absorb the financial loss yourself or purchase a rider. This optional add-on targets a specific item and overrides the cap, fully insuring it for its appraised value. Life insurance operates on the exact same logic. Death from natural causes is covered by default, but if you participate in high-risk activities like skydiving, the insurer excludes you unless you add a targeted rider. A baseline policy is designed to protect average assets and average risks. Protecting exceptional value requires you to acknowledge the limits and pay for the specific upgrades. You don't need to read a 50-page contract to bridge the gap between assumption and reality. You only need to check 4 specific pages. By executing a targeted 5-minute audit, you can extract exactly what you are paying for and exactly where your vulnerabilities lie. This matrix charts the anatomy of your policy. Start in the high-consequence, low-effort quadrant with the declarations page. This summary instantly verifies your absolute coverage limits, your deductibles, and your premium costs. Next is the coverage section. A quick scan here confirms whether the baseline protections you assume you have are actually written down. Then you locate the exclusions section. This is the most vital part of the document. It lists every single event the insurer refuses to pay for. This is where the financial gaps hide. Finally, skim the conditions section. If you violate these operational rules, like missing a strict deadline for reporting a claim, the insurer can void a perfectly valid payout. Investing just 5 minutes a year to audit these 4 sections gives you absolute clarity on which risks the insurance company is taking and which risks you are personally absorbing. If you only have a basic summary card in your glove box or desk drawer, call your provider. You have the legal right to request a complete, unabridged copy of your policy at any time. Enduring the temporary friction of reading your exclusions is the only reliable way to eliminate the massive risk of assumed coverage. Knowing exactly what your contract limits are before the storm hits is the ultimate difference between a seamless financial recovery and a devastating loss.